and welcome to Fidelity Connects. I'm Pamela Ritchie. The Bank of Canada has cut its key interest rate by 25 basis points. This is the sixth consecutive cut by the bank, and it brings their key lending rate down to 3%. Now, with Trump's tariff threat looming over Canada, what might this ultimately mean for future cuts? Are they on the table or not? And what might it all mean for the Canadian economy, the Canadian dollar, and your investment decisions? Economist Don Drummond today. Don is a former Chief Economist at TD Financial Group and current Stauffer-Dunning Fellow and Distinguished Visiting Scholar in the School of Policy Studies at Queen's University. Great to see you again, Don. Thanks for joining us here today.
You're welcome.
Delighted to have you here. Keeping an eye on the differential. Let's just go to, we all know what the cut was. We don't need to go over what that was, but the differential now with the US is just becoming more substantial. What do we do with this as investors?
Well, first of all, a lot of the people explain the weakness of the Canadian dollar because our interest rate's below the United States. That's not valid. It makes a bit of a difference. Perhaps the Canadian dollar is depressed a couple of cents because of this interest rate differential. But let's face it, when the gap is big as it is, it's not coming from the interest rate differential. The reason our Canadian dollar is worth so much less than the American dollar is we have this huge productivity gap. It's been there for a long time and it's been growing. It's been growing steadily since 2000. It's been growing in a major way over the last couple of years. And so we, in a sense, need this low value of the Canadian dollar in order to be reasonably competitive with the United States. So we have these lower short-term interest rates. At the very long term, our bond yields are a bit lower, but most of the interest rates are roughly in line with the United States. The Federal Reserve Board didn't cut, and I think for valid reasons. The U.S. economy is doing quite well. The unemployment rate is low. Employment has been growing at a fairly steady rate. They, like the Bank of Canada, want to see inflation at 2%, and it's still running a little bit higher than that on an underlying basis. Wages are going up at a fairly reasonable rate. So I don't think we can really disagree with their decision to hold the rate, and nor could we disagree with the decision of the Bank of Canada to lower this. Right. Employment's been growing very rapidly in Canada as well, but we do have what the Bank of Canada would say is an output gap. We're below our potential supply, and so a cut in the interest rates is warranted. And so it's a negative differential. I don't think it makes a big deal one way or the other. Okay,
really interesting. Such an amazing perspective. Thank you for setting us straight there. Obviously, the commentaries were on the same day yesterday with the Bank of Canada and the Fed, and today was the EU. We heard the Eurozone comments on their own story. Going to yesterday, there was a marked difference in how they tackled tariffs. They're obviously on totally different sides of the story, but Tiff Macklem really went there, didn't he? He really answered questions. He offered comments and then answered questions. He basically said that the Bank of Canada can't do much but help our economy adjust to the reality. Is that basically, how do you make that?
The two extremes of yesterday's monetary policy report are almost funny in a sense, because the first 90% of the report looks like a carbon copy of the previous reports, where they changed the dates and they updated a few of the numbers, but the sentence structures are almost identical, same old, same old. And then out of the blue, they've got this really intriguing final section, which is the possible impacts of the tariffs. I give them a great deal of credit. There's huge uncertainty of what the economic effects would be. We haven't seen tariffs like this in decades and decades. None of the models they have any experience covering what a tariff would be. And to their credit, they know there's a lot of uncertainties. What would be the pass-through of the tariffs to prices? How sensitive is U.S. demand to the price of Canadian exports? And we don't know a lot. So they gave a range. But they did suggest that if the United States levied 25% tariffs against all trading partners, and all trading partners reciprocated with their own 25%, Canadian output would be down 3 to 4%, the level down 3 to 4% by the second year. And then it would kind of stay at that lower level, and prices would go up somewhere around 1 or 2% because tariffs do raise the prices. And I do wonder, does that even really fully capture the downside of it? I'm quite struck by a recent survey by KPMG that found in the early days after Trump's threat of the tariffs, 48% of the respondents from large corporations said they are already planning more investment in the United States or even moving to the United States. And they're basically getting, the implicit message behind this is if you want to sell the United States, you better locate your production and your offices in the United States. And it seems like even without the reality of tariffs, Canadian companies are already doing that. And that's not something where the dust would settle in 1 or 2 years. That could have an ongoing negative effect. So kudos to the Bank of Canada for taking that out, informing us some degree better than we were before. But I do worry that they might not even have captured the full downside of that threat.
So let's ask you to answer this one. Why aren't corporate taxes the number one policy issue in this country, based on what you just said?
Yeah, so this is really a wake-up call, if nothing else. Hopefully the threat won't come to pass, but we should not sit back and just ignore that. We have to do whatever we can to be more productive and more competitive. We have to face a world where maybe the United States is not our steadfast, almost low trade partner. We've got to be able to compete with other countries and sell on to other countries. We've got to reverse this dismal productivity. And there's no silver bullets here. You got to do what you do. Interprovincial tariff trade barriers gone. They've got to be gone. They never should have been there in the first place.
Is that, how material is that to our economy? What is
not
it
that
worth?
big? The Conference Board estimated 0.3 or 0.4 lift in the level of GDP. You got to count whatever you got to do, and they shouldn't be there in the first place. But they're not going to dramatically change the nature of the Canadian economy. Beginning in the budget in 2000, we started to create a corporate tax advantage for Canadian companies, particularly vis-a-vis the United States, but that has since disappeared. Not that our taxes have come up, but other countries, including the United States, have been reducing theirs. It's time that we reintroduce a corporate tax advantage. Unfortunately, the government has left us in a woefully dissatisfactory fiscal position. Deficits over 40 billion, debt to GDP ratio over 40 billion. We cannot just cut taxes unless we have at least a corresponding cut in expenditures, which have just ballooned over the last couple of years.
Yeah, no, it is, in some ways, there are some insurmountable tasks here. But anyway, it's got to be tackled in any case. Talk a little bit about the inflation story. So Tiff Macklin kind of started out actually looking at, inflation a year ago, where we've gotten to, the trajectory that he's basically happy with. In a way, some of this is ancient history because we are so focused on what tariffs will mean. But just talk about the trajectory of inflation and, kind of what you're projecting on the inflation front, if you can.
Yeah, well, first to note, you can't help but detect smiles on the faces of the people who wrote the Bank of Canada Monetary Policy Report. It opens up that we think inflation will be around 2% over our projection period. We have an output gap. In other words, aggregate demand is less than aggregate supply right at the moment, but we think that output gap will be closed over the projection period. Those are the things that they want to see, and they say they're confident that they will see them. Of course, they don't tell us implicit in that what is the interest rate path, and we can only guess that it's probably one more cut, which would take them to 2.75, i.e. the midpoint of their current estimate of the neutral rate. So they're pretty content on that side. Put aside the tariffs for a moment, some of the risks they see is that perhaps the housing market, shelter prices have been the Achilles heel of inflation in Canada. Shelter prices have been increasing at an enormous pace. Rents have actually started to come down a level. We're starting to see some new builds for the first times in decades across Canada on the rental side. So maybe there's some relief coming. They do note that housing demand may be stronger, and they do refer to the relaxation of some mortgage rules, such as the reintroduction of the 30-year amortization. This Bank of Canada, when they take a shot at the government, they are always so subtle. They don't want to be very direct in there. That's a shot at the government that was not welcome from their perspective, but we do have that. But they don't seem to play a lot of emphasis on the non-tariff risk. Obviously, they're very concerned about the tariff risk, and they know very explicitly there's not a lot that they can do about it because you're simultaneously going to depress output. You're going to have a lot of job loss. But you're going to raise price level, and they would worry about that of an inflation kick. One would think when they're in a wrestling match between weaker output and this price level effect of tariffs that they would lean in and lower interest rates nonetheless.
Yeah.
Because
Which
the tariffs
did.
are a one-time price adjustment, not a shock to inflation.
Okay, let's go into the shock to inflation. Economic shocks, generally speaking, can be short-term or longer-term and have longer legs. It sounds like the tariff threat is a shock in itself. Talk a little bit about that shock to our economy, what it's worth ultimately in terms of interest rate cuts.
Yeah, well, first of all, I think we want to emphasize, and you correctly used the word the threat. The threat itself is a shock, not even the actual tariffs, because it is sending a note to everyone around the world. If you want to do business in the United States, you have to be located in the United States, office-wise, production-wise. If the threat goes on for 10 years and it never manifests, well, then I guess it dissipates, but the threat stays alive. And the last thing I want to see, if again, we don't see the imposition of tariffs February 1st, I don't want to hear any sighs of relief, because the message has been sent and we better react to that. And of course, from a theoretical perspective, it's not in our interest to retaliate, because that hurts us further, but you have to bring in the dynamics. If you're being bullied, you have to push back, or else the bullying never ends. So you actually have to do something that's paradoxical. You have to retaliate, and that will hurt us even further. So yeah, a substantial reduction in our output, but an increase to our price level, but not necessarily an increase in inflation. I don't expect if prices went up in Canada, you're going to see a round of higher wage increases. They didn't speak about the employment impact, but if there was a 3 to 4% drop in output, and let's just say for the sake of argument, that lowered employment correspondingly down 3 or 4%, that's 600 to 900,000 jobs. I mean, you're rounding up, you're talking about 1 million job loss. Premier Ford had referred to the possibility of 500,000 job losses. The Bank of Canada's estimate, somewhat less than that, but it shows that that estimate, even $500,000, is not out of the realm of the possible. That's a huge negative shock. The Bank of Canada would lower rates further, but again, because there's not a magic bullet in that. We're at 3 right now. I mean, at the extreme, they could go down to a quarter again.
Yeah.
But that's going to have a limited effect. We have seen from previous rounds of things like quantitative easing, you can introduce some tools to get down long-term bond yields, but those only lower bond yields 10 or 20 basis points at most.
So that's really interesting, because that was a question yesterday. Like, would you pull out the bazooka of quantitative easing? Would you print money if things got tricky? What say you? I mean, he said no. I guess he was always going to say no to that question.
Well, I would say you would do that, but we have the experience now that it helps, but it doesn't make a huge difference on the quantitative easing, whether you do it or not. But that wouldn't be an argument for not doing it. I mean, oddly enough, and I hate to put it this way, in some sense, we have the benefit of having gone through the crisis experience of the pandemic. We know what you need to do on an extraordinary emergency basis on the fiscal side. And there were hints from the government that, hey, we would not hesitate to introduce pandemic type measures like the extension and the increase of employment insurance benefits. And the Bank of Canada has exercised these weapons during the pandemic and would know how to exercise them again if they're needed.
Fantastic. Okay, let's talk a little bit about our dollar. You mentioned it there earlier, but it has weakened again with the threats. I mean, that's sort of the story there. They're hanging over. There's a looming discussion. It helps with exports. That's always the silver lining. There's an expectation. Tell us a little bit about exports.
Yeah, I'm not even really, in the short term, it does help with exports. I'm not even convinced over the longer term it does help. I don't want to use that term, the lazy manufacturers hypothesis, but it is there in the background. You get hooked on a lower value of the dollar and it doesn't push you to be as competitive as you might otherwise be. We've talked about this as a number one concern in previous shows, the weakness of Canadian business investment. That does not bode well for our future. Maybe you can survive with the undervalued Canadian dollar in that environment. You cannot be competitive with the business investment environment that we've had of late, and that's got to change if we're going to be a stronger Canadian dollar economy. The Canadian dollar being weak actually plays against you, because the majority of imports of things like machinery and equipment, investment in machinery and equipment, is imported, and you pay more for it when you have to pay out a cheap Canadian dollar. So it's not unambiguously a help even for exporters. I would rather see a more productive competitive Canadian dollar with a much higher value of the Canadian dollar.
So let's talk a little bit about, you're a renowned economist. You are trained to look backwards and forwards. How is manufacturing going to possibly transform? Because that's where all this is going to hurt. The manufacturing side of this country is potentially going to get hit and has to sort of evolve, enter the AI story. We know about it. What do you see? I mean, take Ontario as an example. There are other manufacturing hubs across this country, but the Ontario manufacturing sector, what can it do? What would you like to see it do?
Well, first of all, we have to recognize when you pull out the economic textbook and they talk about small open economies, that is Canada. We are the quintessential small open economy. We're very small in terms of world output. We're never going to have a large thriving manufacturing sector that sells solely into the domestic market. It's just not big enough to build that kind of scale. So we have to have trade arrangements and open trade with other countries. And that's why we have to resolve this difference with the United States. We have to have trade agreements and expand our trade networks into other countries. And then we have to build up the investment side. So we are the state of the art and we have much higher productivity. We have to build upon our assets. One of our assets is we have a highly educated labor market. We have a diversity in the Canadian population that has reaches into countries around the rest of the world. We have things that we can build upon, but we need that global trade platform and we need a much more productive, larger sector. We need to get rid of this phenomenon where companies grow to about $500,000 of annual sales and they sell out or they remain content to stay there. And we should blow up this distinction of the small business, large business tax. You pay almost no taxes as small business. All of a sudden you pay the full rate when you get bigger. That doesn't make any sense. Why do you reward a company for being small? But it speaks to the mentality. We're content to not have growing, thriving, large businesses. And we're content to, in a sense, subsidize businesses that remain small. It makes no sense whatsoever.
It's fascinating. So when you look to policy change, I mean, you're all endless committees to discuss this. Does it go to education? Where do you see this next?
Well, I hate to say it, but you yanked my chain with the word education. I am extremely upset, and I will declare my transparency. I do work for Queen's University. The post-secondary education system in Canada is under attack. It is one of the greatest assets the country has in terms of reducing a highly educated labor force. It's the source of about 30% of the research and development. It's actually a source of a lot of the commercialization, and it's under attack from every front. Most of the provinces have cut their funding. Provinces like the government of Ontario have frozen tuition, so the universities can't build up. And then they created a situation where the universities and colleges had to turn to foreign students to create a revenue flow, and now it's cut that off, and it's left them dangling on every perspective. We're going to have a weaker education product. We're going to have less research and development. We're going to have less commercialization. How the governments of Canada and the people they represent don't get that is beyond me. But I think it is a sector that I think it's fair to say it's a sector in crisis. And it is a manufactured crisis. It didn't need to be that way, and it doesn't need to be that way. And I get it, the populist thing, like let's freeze tuition and that'll make students happy. Well, how about not having a decent education? How's that working out for the students? I get why you won't want to pay a high price for it, but it's better to pay something than to have the poor outcomes that we're going to get inevitably from the budget situation now.
Question on immigration, part of it linked into exactly what you're talking about there. How does the reduced immigration story impact Canada's economy? Education is a piece of it. Maybe spread it out a bit.
Well, it's not just about numbers, and I think that's where we went wrong. It doesn't really matter how many people we bring in. We want to bring in people that are going to be successful themselves. They're going to integrate satisfactorily, economically, socially into the Canadian economy, but they're going to add to the Canadian economy. And we just flooded Canada trying to fill low-wage positions. That was the wrong approach to have. We had way too many temporary workers who are not making a permanent contribution. They're not doing very well themselves, typically treated horribly. As the Minister of Immigration, I give him a great deal of credit. He says the system got out of control. He's absolutely right. You don't hear very many politicians, but they presided over that. They're trying to rein it in, but in reining it in, there's collateral damage, like the hit to the budget of colleges and universities. But then you look at it, coming to colleges, they created, some of them, not all of them by any means, but some of them created the equivalent of the puppy mills, where they created programs where they're not even actual students. And, the Auditor Generals have confirmed the whopping percentage of students who are not even in a legitimate program. We totally let the thing get out of hand. We have to rein it back in, but we have to focus. What kind of immigrant are we looking at? What are the conditions that we need? We want people with experience. We want people with education credentials. It helps if they have some fluency in English and French. Those are the kind of conditions that determine they are going to be successful and they're going to make a contribution to the Canadian economy. Get over our obsession with numbers. It probably does mean for a while the numbers have to be quite a bit lower than they were before. You know, I was shocked. I did a note recently deploring really the headlines that are saying the increase in the Canadian unemployment rate indicates a weak labor market. It's exactly the opposite. Employment's been increasing at a rapid pace. I hear stories, young people can't get jobs. Employment of young people has been increasing at a rapid pace, but in the last year, the Canadian population of people 15 to 24 increased by 7.7%. I would have never thought that was remotely possible. Like the mathematics of that still just stuns me. But of course, a lot of that is the student visas that went crazy for a while. No wonder the unemployment rate for young people went up. That doesn't say the Canadian market is not creating jobs for them. It couldn't possibly increase employment for young people 7.7% in a short period of time. But it's so distressing that a government couldn't see its way and organize through that. You know, we have the 6 million Canadians who don't have a registry to a permanent caregiver. Well, no wonder the supply of doctors is increasing 1% a year and the population is increasing more than 3% a year. We build about 250,000 housing starts per year, and our population went up way over 1 million per year for 3 years running. How does somebody not bring these files together and realize that this is going to create a problem? This is not intended in any way as anti-immigration. Obviously, we have been formed, largely our population, other than the Indigenous people, are formed by immigrants. And in most cases, they've been very successful, but that model has been broken and needs to be fixed.
So it's very interesting. There's a couple of questions rolling in here. Let's talk about, so this again is getting down to brass tacks of productivity, this question, but how can Canada strengthen itself significantly and quickly do so, so that we're not, they're asking, at the mercy of the US?
So as you mentioned, I think we do need corporate tax rates. I think our fiscal situation means that it has to be fairly limited. It has to be accompanied by a very deep round of spending cuts, reversing some of the excesses that we've seen over the last number of years, not just since the pandemic. We're really going back to 2015 and 2016. I don't like things like I'm just about to suggest, but I think it's necessary. We probably need an investment tax credit. We need to extend the accelerated depreciation allowances. And somehow we need to create a culture in the Canadian business community that they want to expand and thrive, and they're going to be willing to invest to do that.
How much is the mortgage story in Canada? I mean, it's one big piece of the economic story here. Is it ring-fenced sufficiently? It's seen, it's a known risk at this point. Is there a way to sort of allow that it's there, but kind of move on from it in terms of the growth story in this country? How much do we have like a big boulder in front of us, or maybe we don't?
Well, a year or two ago, there was no shortage of horror stories, and you could well imagine that. There are a lot of people who hit the jackpot. They got a 5-year mortgage as low as 1.65%. And even at that, they were stretched because they had such a big amount in their mortgage. And you knew that even if interest rates came down, and they did come down, you knew they were going to have to renew at a multiple of what they had. And so that's going to create a very serious loss for them. There's going to be a lot of defaults. And we haven't seen that so far. The Canadian household has weathered the transition to higher mortgage rates quite well. Where there have been defaults and not that many, the housing market has been sufficiently strong in most markets that the lender has been able to sell the property. So they haven't had a huge financial hit. We know from surveys and the actual data that people have actually been pre-saving. We've been paying down. A lot of the mortgages allow you to pay 10 or 15% without a penalty. We see that people are doing that. They're doing everything they should do. And I'll come back and I'll give credit to our office as superintendent of financial institutions. Boy, they got criticized like you couldn't believe when they introduced those stress tests, that in order to get mortgages, you had to demonstrate that you could afford it at a rate substantially higher than the prevailing rate. But I think that saved us to a large degree. And the reality is the stress test came about and people did face increases of 1 percentage point, 2 percentage points in their mortgages. And we knew from their credit scores that they were able to withstand that, albeit, and I don't want to downplay this, squeezing out virtually everything else. I don't want to pretend for a moment that this has been easy for them. Goodbye holidays, goodbye trips out for a meal, despite the temporary tax break and all the like of that. Things are tough, but they're coming through it so far quite well. But let's not forget, this shock doesn't end. If you took a 5-year mortgage in 2022, the math's pretty simple. You don't get your shock until 2027. So this isn't over yet.
Okay. All right. So it isn't over yet. That's the clip I was looking for, to be honest. That's what I want to hear, what your thoughts were. Let's talk a little bit about the oil and gas sector. It is, massively material to our economy. It has been less so because of lots of different policies and so on. Where do you see it from here? I'm going to assume that the oil price isn't going to do anything too crazy to the upside. Where do you think it fits in terms of our ability as a country to make sure our economy is, diversified?
Well, I'll put the tariffs aside for a moment.
Sure.
Again, 2 or 3 years ago, there was no shortage of articles that this is the end of the fossil fuel. Everybody's converted to renewable. We have had since the inevitable result. As soon as things like carbon pricing seems to impact somebody, they want to run away from it. And of course, we have the extreme in the United States, drill, baby, drill, fossil fuels, suppressing the renewable energy. That will be temporary. It is the future. And in fact, the United States is handing a huge card to China, which is dominating the renewable. They're dominating the critical minerals. They're dominating a whole bunch of fields in this. The United States is going to cede fields of that. Canada better to do that. And the credit of the oil and gas companies in Canada, they're heavily into the renewables as well. So it's got longer legs than everybody would said for a year or two. They're cleaning up their act. They're reducing their emissions. So I think their prospects, while that's not going to be a growth leader forever, we are going to move away from a fossil fuel base at some point, maybe not as fast as some would like or some would have predicted, but we will eventually move from that. But the companies are being diversified. Now come to the tariff threat. Trump keeps referring to this big deficit. I don't think many people realize it's almost all in oil and gas and electricity. And the big one is in oil. And it heats and provides the air conditioners for much of the Midwest of the United States. And it's not easy for them to reduce their dependence upon it. The refineries that handle that are based on Canadian crude oil. They can't switch their formula all that easily. The pipelines run from the south to the north. They don't run the other direction. You can't switch those around very quickly, which makes you kind of think if there were going to be tariffs, they'd probably have a carve out for the oil and gas. We'll have to see that. Of course, if Canada actually put on an export tax itself or prohibited the production, that would hurt the sector. So I would say longer prospects, not that bright if you remain solely in oil and gas, but the companies are diversifying better than you would have said before, but hold your on the edge of your seat for the next little while of how oil and gas is going to get caught up with the tariff threats from the United States and the possible retaliation from Canada.
Okay. Leave us with what we can look forward to maybe 6 months out as a drop of hope. Sounds like the early part of this year might be dominated by everything you just discussed. But on the other side, what could actually come together? Give us sort of a final thought here, Don.
Well, I'll list my 2 wishes. Number 1 wish is we don't have these tariffs, and my number 2 wish is Canada doesn't heave that sigh of relief and realizes this is a signal we need to strengthen our economy, and we are getting on with that job.
Okay, fantastic. Don, we are delighted to always have you here. Everyone joins in to hear about you. Don Drummond, well-renowned economist in this country, joining us to take us through the Bank of Canada and tariffs. We look forward to seeing you again soon.
Thank you very much. Bye.
Thanks for listening to the Fidelity Connects podcast. If you haven't done so already, please subscribe to Fidelity Connects on your podcast platform of choice. And if you like what you're hearing, leave a review or a 5-star rating. Fidelity mutual funds and ETFs are available by working with a financial advisor or through an online brokerage account. Visit fidelity.ca/howtobuy for more information. On fidelity.ca, you can also find more information on future live webcasts, and don't forget to follow Fidelity Canada on X. The views and opinions expressed on this podcast are those of the participants and not necessarily reflect those of Fidelity Investments Canada ULC or its affiliates. This podcast is for informational purposes only and should not be construed as investment, tax, or legal advice. It is not an offer to sell or buy, or an endorsement, recommendation, or sponsorship of any entity or security cited. Read a fund's prospectus before investing. Funds are not guaranteed, their values change frequently, and past performance may not be repeated. Fees, expenses, and commissions are all associated with fund investments. Thanks again, and see you next time.